Just to give a little background on myself, not much, just so you know who I am. I've been in this industry for now more than 30 years. I've worked, started out as an engineer and have worked both in North America, but also quite a bit of time internationally, both in the Middle East, Asia, Latin America, and Europe also. So I've been spent about a total of 14 years overseas during this time. So the first thing I want to do is just give a quick overview of who Stratus is, and then so you have an idea of who we are and what we do. As mentioned, we are associated with Hart Energy. They're our parent company. Hart has three groups: publishing, which puts out magazines like E&P, Oil and Gas, Investor, and so forth. They have the conference group, which puts on the main events that they do are the Doug events, and we have coming one up in Pittsburgh called Doug East soon in June, if anybody wants to attend that. And then the third group is the research and consulting arm, which is Stratus Advisors, and that's the group I oversee. So we are a global research and consulting firm. We're headquartered here in Houston. Other offices in the U.S. are Washington, D.C. and New York City. Overseas, our main Europe office is Brussels, and our main Asia office is Singapore. So we have a global client base that covers the whole value chain. So we cover upstream, midstream, downstream, which includes refining and petrochemicals, and what we call fuel and transportation. So really a whole well to wheels. We also cover the macro level factors that affect the energy and related sectors, so geopolitics, macroeconomics, and policy and regulations. What we're trying to do at Stratus is help our clients understand not only what's going on today, but what the future markets will be, what's the future competitive landscape will be, and how do they position themselves for that future. What's the right strategy in terms of portfolio, strategic initiatives, how do you move forward, how do you position yourself to take advantage of the upside potential, but also protect against the downside risk, which, as we all know, there's risk in this business. So our client base includes all the international oil companies like BP, Shell, Exxon, so forth. National oil companies like the Saudis, the Kuwaitis, the Chinese, and so forth. We do a lot of work also with the independent producers, independent refiners, midstream companies, technology licensors, service sector, and we also do work with the financial sector. That's why we have the office in New York. A lot of work with the asset management, hedge funds, and private equity, and also government agencies. Our staff includes technical people, so that's our engineers, geologists, petroleum engineers, process engineers, and also mechanical engineers. And then we have the typical, what used to be very typical, the engineer with the MBA that then becomes a consultant. That's my background. But we also have economists, those who have PhDs and advanced degrees, also financial analysts, such as CFAs, and also those who have advanced degrees in political science. So with our broad client base, the diverse background in terms of experience and education, we're able to look at different perspectives of the energy sector. Not just look at it from the viewpoint of an oil company or a service company sitting in Houston, because not everybody looks at it that way. And it doesn't always move in the way that might be best for somebody in Houston. So we try and bring what we think is going to happen. We try and understand the different viewpoints of stakeholders and how that will shape the future. Okay? So now I want to talk about the presentation this morning. So first I want to start out talking about our short-term outlook. In light of what's happened with the OPEC meeting in last week, to go through that, where we see the oil markets going. And then I want to at a high level give an overview of what we see from a longer term perspective and how we see a range of outcomes and scenarios and how we see the future looking and what that could mean for, as I said, for risk and also opportunities. Okay. Well, OPEC announced last week that they were going to extend the production cuts for another 9 months. And the market was not impressed with that, right? So we had pushed up again to around over 55, almost back to $56 on Brent, I'm talking. And when the announcement came out, the market was not impressed that there was only a 9 months, that the cuts were not going to be further expanded to cover countries like Nigeria, Libya, and so forth. And so we saw a correction, and now today we're back down. Brent yesterday closed at $50.65. So we keep oscillating in this range of $50 to $56. And we bounce up to 56, and then the market shifts and we push back down. So where do we think we're going to be going with this? All right, so if we look at the key takeaways that came from the OPEC meeting, and we actually had people on the ground there in Vienna, and we're there trying to catch the buzz and understand what the different, what are some of the messages that were coming out, official and unofficial. And this was what came out of that my short-term team was there. So they indicate 9-month extension. That happened, but it was already priced into the market. For some reason, the market got the idea that we needed more, that there was going to be more. And we don't expect OPEC to be super aggressive in announcing their intentions. I think what they want is the market to have a level of uncertainty. They wanted the market to slowly come back, slowly increase that floor price, but not make it so certain that shale players in the U.S. feel that they can just go out and start hitting it and pushing forward. That they want to leave that idea that there's a risk that you could have another downturn in the oil price. And I was talking, there is earlier, so when you look at their strategy right now, they would say it's working. Not as well as they would like, but it's definitely working. They have slowed down the increase in non-OPEC production. They have pushed out or helped cause higher ticket, more expensive projects to either be canceled or pushed out. So that's definitely helping. The deep water, some of the oil sands and so forth, those projects are being delayed or pushed out. That's very good for them. They've also, of course, put a crimp in shale. Now shale's coming back, and they're watching that. OPEC understood that shale would come back. They just want to make sure it doesn't come back too fast, too aggressively in terms of additional production. The risk that is always out there that they want people to be aware of, and they let these messages come out, is the other strategy they got is to crush the market one more time. Right now, Saudi Arabia is producing 9.7 million. They could easily push it up well above 10 and crush the market again. Right now, that's probably not the likely strategy that they'll have, because their OPEC members, such as Venezuela, Iraq, Iran, are not in the position to take low oil prices as they are. Saudi Arabia still has lots of reserves, cash reserves, dollar reserves. They have an ability to access the debt market, which other countries do not have. Venezuela today can't go to the debt market and raise any money. Even Goldman Sachs might not lend them any money. So, so they're not in that position to do that. So, and Russia also is vulnerable. Their economy's taken a big hit, and so right now we expect that Saudi Arabia will go forward with this and try and extend the cuts and help rebalance the market. Okay. So that's that. Now, some of the things that are causing why the market was concerned was the Nigeria, Libya. So we've seen in the news in the last couple of days, Libya production has come back a little bit. Nigeria could come back. There's probably 700,000 barrels that could come back there. Libya was producing around 400,000. They could go to 1.4 if they could get their issues resolved. We don't think either one of them will get their issues resolved. Nigeria has always got issues. Libya is still a mess, and we don't expect that to be resolved. So we expect that there still will be issues there. Okay, so our team had put out a webinar and some views before before the OPEC meeting. And so this is go back and look at that. So one of the things they were hoping was deeper cuts coming from other areas than Saudi Arabia. That didn't happen, okay? They were hoping it would extend beyond 2017 through past March. That did not happen. They were hoping to see, our team was seeing that we're starting to see some pressure on shale cost structure, and I want to talk a little bit more about that. We are, and from our viewpoint, we're starting to see that, and we think there's some pent-up cost increases that could come forward, and it's going to have an impact on the break-evens and so forth. They were hoping there would be some issues on Libya and Nigeria. That did not happen. And so what we had was this reaction over that the market did not react favorably and continued to push the price up, okay? So at the end of the day, we think fundamentals, though, will have a big impact on the oil price. So if you look at this chart, as you know, there's a lot of noise that we're well above the 5-year average in terms of inventories. Right, and this has built up over the 2014, 2015, 2016 time period. It started to build up, and you can see, if you look at the upper reddish line, that's where we are today. The idea is with these cuts, though, that you can drive back and get close to the 5-year average. So that we think that can happen if we continue to have demand, we continue to have discipline with OPEC, and we don't get too much of a ramp up in non-OPEC, including shale. So we think this can happen, and we think as we start to see signs of this rebalancing happening, it will start to put further support under the oil price. Okay. So what have we seen in recent times in the U.S.? Definitely, we've been having draws on crude oil. That's been happening. And we've also seen draws on products. So diesel, for example, inventories, which had gotten quite high, are now about 6 million barrels below what they were a year ago. And they're coming back more normal. And then we continue to draw on diesel, which is a good sign, which is a sign of strength in the U.S. economy, because diesel demand had lagged the last couple of years. But this year we're seeing strong growth in diesel, somewhere above 5%, 5, 6, even 8% we're seeing some during some times. And so that's helping draw that diesel demand down. Now part of that is return activity in the oil patch, we're also more freight movements and so forth. So that's a good sign. Gasoline demand is about on par where it was a year ago. Our gasoline stocks, inventories are about the same, though we expect to start to see some draws on gasoline. Earlier in the year, we were seeing some weakness in gasoline demand in the U.S. But what we were seeing very strong export growth in gasoline for the U.S. So if you added up exports and demand and compare them to a year ago, we were about on par. Now, part of this could be an allocation issue with how the EIA is allocating where those barrels are moving, because they do not have perfect information. But it's also something that we are expecting to just start to see in the U.S., where we start to see a plateauing of gasoline demand because of structural changes to the vehicle fleet. And when we start to see that over time, we expect gasoline demand to start to decline over time. But right now we're seeing that market's gasoline demand's picking up, and we're starting to see inventories hold and now start to come down there. So we're starting to see some rebalancing in the U.S., and that's the one that everybody can see. It comes out weekly, so a lot of people pay attention to that. All right, so before the meeting, our team had developed 3 scenarios. One was that the OPEC would stop, it would not extend the supply cuts at all, and it would end in May. That's the red line, and you could see how the production then would bounce back. The black line was the deal ends in December. That was the original thought, that they were going to extend it another 6 months, and they actually extended it 9 months. And then the green is if they extend it all the way through 2018. And I'll show you where we think that OPEC is more likely to keep extending these cuts beyond the 9 months over time. And I'll show you why. So if you look at this is the supply-demand balances and the impact on stocks, right? So obviously a negative is a draw on stocks, positive is a build. So if you look at what we've been doing, we're starting to, if we follow scenario 2, which is the cuts being extended, you can see that we expect to draw and continue to draw all the way through 2018. And this will get us a much tighter oil market and would really put support under the oil price. And if you think about it, there's not a lot of spare capacity out there, right? If you look at spare production capacity, you get beyond Saudi Arabia, some of UAE, Kuwait, and so forth. That's where the spare capacity is. So with demand growth growing at 1.3 million barrels a day, and you have OPEC pulling back, you now have demand higher than supply by about 1 million barrels a day. So that's going to start to show up in the numbers, if we will. But you can see what happens if they don't extend it. So if they only would have ended it at the end of the year, you see we get back into builds we do. And so we expect that OPEC will continue to extend these cuts, they will. And as long as Saudi Arabia can pump around 9.7 and they can maintain the compliance around the cuts, we think they'll be happy to continue to extend this. And remember, OPEC has Saudi Aramco is going to do the IPO, or wants to do an IPO. So it's in their interest to make sure at that point that the oil market is showing more stability and the prices are more stable than where they are today. Okay, and this is why I said iterate that point. If they don't extend the cuts, then we're back into builds again, and that's the issue they're going to have until we go out another couple years and we get these inventories pulled back down below into the normal level. It's in their best interest to keep extending these production cuts. Now, that's one factor. What is OPEC and the cooperating countries with like Russia and so forth, and what they're doing on the production side? But the other is then what's happening on the shale side. So the market's watching very closely inventories, and they can see that there were some issues there that were still elevated, but we're starting to see some drawdowns. But they're also watching rig counts, or looking at the production numbers keep going up, right? So we're back to around 9.3 in the U.S. production. So we've had a big bounce back here. But we're seeing some signs that this will start to moderate this increase. One, we're starting to see there was definitely getting higher oil output per rig, but we're starting to see that plateau. We also, as you can see in the upper chart and then the lower chart on the left, where you can see the rate of change is starting to slow down. And then if you look at the right chart, you can see the productivity gains versus the cost inflation. And we're starting to see some pressure on cost side, right? And as that cost goes up, which we think could go up higher, there's going to be affect break evens, it'll affect cash flow, and we expect that will force the shale guys to pull back and not be able to move us forward as aggressively as they had in this rebound. Long term, this could be a good thing, right? It's a self-correcting mechanism that will allow the market not to get out too far in front of itself. And we think why we think there's more. What we're seeing today is operators are drilling, but they're still not completing wells. DUCs are continuing to increase, partially because of the cost. But we expect them, when they want to start to complete that wells, that's going to put even more pressure on the completion cost and make it even more costly. So what does this all mean in terms of our price outlook? So if you look at the scenario 3, which was what would have happened if OPEC didn't move forward with the cuts. Now this one we know it's not happening because they actually did. But you could have seen we would have dropped back to below 50 and we would have expected further pressure in oil to keep hovering below 50 with that. The black is if they extend it to the end of, for the end of this year. Now we know they're going to go beyond that. So if you look at the scenario we think we're most likely on is the green scenario, which is where we'll be back up. If OPEC holds and extends the cuts through 2018, we see us getting back up around well above $60 at this point. Now, how accurate have we been? Back in January of 2016, we had an event in Houston at the Omni Hotel, and we stood up and bravely told people when on that day oil prices, Brent was at $26, we said Brent was going back to 40 in 3 months. Well, we were right that time. And we've been very accurate since then. This is somewhat of contrarian. We don't see, there's some people, I would say the market as a whole is more bearish on oil prices than we are right now. But when we add it together, what we're seeing with demand, what we're seeing with supply, what we're seeing with inventories, and what our model is shooting out, this is what we're leaning towards. We'll think we'll be back above $60 here in the next year, and that we will actually peak $60 here yet in the Q3 of this year, which is really the highest global demand happens in Q3. That's when you have Asia demand really picks up. You still got, U.S. is still in the latter stages of driving season, okay? So this is our view. So I don't know if any reaction on that. If not, I'll move on and talk about our long term. So I wanted to, I thought it'd be interesting to talk about our long-term view and where we see oil going over the next 20 years. I was in Asia. It's something I've talked, I just got back from being in Southeast Asia and Singapore and Malaysia, and then I went to Japan, and then I was in India, and then I ended up back in Japan and then the US. So there was a big conference in Asia called the Asia Oil and Gas Conference. It's held in KL, and there were people there that were talking and implying that there wouldn't be much change going forward, and that electric vehicles was all hype, that today the future will be pretty much the same as today. Well, our view is that's not going to be true. The future is never the same as it was in the past. I remember when I first got into the oil industry, I was told oil's going to $100, and it went to 10. Then I was told that oil was going to stay 10, and it went to first to 40. And I remember one of the CEOs testifying in front of the Congress saying oil was, that was a good price for oil. Then it went to 147. And then Goldman Sachs said it was going to 200, and it went to 40. So I don't believe the future is going to be the same as the past. And I think we're and every generation thinks this. I don't know what generation, but when you live, everybody thinks their time's the most interesting times, but I think we're living in some pretty interesting times right now. It was interesting. Everybody in Asia wants to talk about President Trump. Every news channel in the world, the BBC, CNN International, it's Trump 24 hours a day. BBC covered more about Trump than they did their own election coming up. I saw very little about Theresa May, but I saw a lot about Donald Trump. But so there's that factor, what's happening with the U.S. But there's also these big geopolitical shifts happening. We're probably at more risk now from a geopolitical standpoint than we've been since the 70s, right? When we had the Soviet Union. We had war between India and Pakistan. We still had the Vietnam War going on. We had the fighting in the Middle East. We've got some big things happening. We have multiple wars in the Middle East, which could really break out to wide sectarian war. We have China rising. Typically, the world hasn't resolved rising powers very well. We have shifts in the Atlantic Basin, and we have the U.S. is not what it was in 1980, right? We now have $20 trillion in debt. We now have slow growth. We have huge problems we're facing. This isn't 1981 with Ronald Reagan. We're not going to be able to play those same cards again. Just cut taxes and we're going to be there. So there's these big shifts that are happening there. So I just want to put that in context of what we see with where we see oil going forward. So if you look at this chart, and this is not very good, so I apologize the detail. But the main point is the world was Atlantic Basin focused. It was Europe. It was the U.S. The oil was set up that way. It was to move oil to the U.S., move oil to Europe. They were the dominant powers. Every global agency or like IMF, World Bank, NATO, United Nations was set up with Atlantic Basin focus. That's not going to be the future. If you look at this chart, you can see by the time we get to 2035, Asia is going to represent 40% of the world's GDP. Some people think the U.S. is an Asian power. You add Asia and you add the U.S. together, that's going to represent 2/3 of the world in terms of GDP. It's going to be dramatically different. India is rising. India is the fastest growing economy in the world right now today. 1.3 billion people with huge demographics advantages right now where they have huge increases in their workforce. So they have a very aggressive prime minister who's doing things to support economic growth. So there's going to be growth there. China's still growing. Then you look at Southeast Asia, that's another 650 million people. And when I went to Asia in 1997, it was all about the Asian tigers. Of course, my timing wasn't very good. The Thai baht crisis happened, and we ended up doing restructuring instead of growth strategies out there. But that's still a huge powerhouse out there when you look at that. So this is where the action's going to be, and that's going to shift. So what we have today can't hold. It's not going to hold where you've got France and